But I want to get into something a little bit too that I think has been talked about from last year that I heard about significantly, and I saw it on a LinkedIn post, was essentially all this money's coming due from the financing
Yeah.
perspective. So we
Yeah.
have this massive maturity wall. Um, and a part of me is so initially I was really nervous about this when I was looking into this topic because I wasn't too sure exactly, what the exact statistics came about.
Yeah.
2025 obviously had a lot of refinancing because, people were taking out, substantial amount of
Right.
3, 5, 7-year loans
Yeah.
on very, very little money,
Yeah.
on very low, low cost money. Essentially cost capital was it was very, very little.
Right.
And now these are coming due. So, what I'm seeing here is like from the commercial real estate perspective, we'll touch on that first. And then I think we should go into the maturity walls related to other stuff. So I have this quote here, and this is from, let's see, Reed Smith. And Reed Smith basically says that many in the commercial property debt sector have warned of a so-called debt maturity wall, referring to a period when a large volume of commercial and multifamily real estate loans is scheduled to mature and potentially require refinancing. So, according to the Mortgage Bankers Association, approximately $875 billion in commercial and multifamily mortgage debt, about 17% of roughly $5 trillion outstanding, is expected to mature in 2026. So this sounds pretty daunting. I mean, that's almost $1 trillion worth of debt.
Yeah.
The aspect there obviously being, can they refinance at, higher rates, right? And from the commercial real estate perspective, it's one of those concepts that we need to look to history on.
Oh, for sure.
And actually, we don't have to look that far. Essentially, the same.
Look at 2022.
Right. No, yeah, exactly. I was going to say 2022, 2023, even 2025. They actually had 857 billion that was due. So basically about 9% higher.
Yeah.
Than now. And essentially, the maturities have declined a little bit year over year, suggesting the overall maturity wave may be easing somewhat, though substantially refinancing needs remain. The problem that essentially people see with the maturity issue is, there's a significant portion of this debt includes kicked cans alone, which is, from 2024 to 2025. They were given 12 months extensions, which are now hitting a higher for longer, obviously, rate environment.
Right.
Now there's the equity gap aspect, with property values in sectors like office still struggling, roughly down like 15 to 20% from peaks. Many borrowers face an equity shortfall where the new loan amount is significantly lower than the maturing balance. The problem, according to Andrew Robinson, who's an associate at Reed Smith, a large share of commercial real estate loans originated in 2010s and early 2020s, many with typical 5 to 10 year terms with lower rates, are now coming due in a tighter lending environment characterized by higher interest rates. So the question is essentially, how well is the commercial real estate environment now in terms of like if we're seeing lower cap rates from the perspective of, okay, higher valuations on the properties gives us a little bit more wiggle room. And then the other aspect too on the refinancing side is, okay, we're refinancing at higher rates now, which is expected. I think, here's the thing about real estate. Real estate kind of goes through obviously cycles like the economy, but you can see them coming a little while out. So I think, if you are a smart real estate investor and you have a property you got to refinance on, the maturity is coming due, you've used up all your extensions, you paid all your extension fees, et cetera, and it's coming due. You, essentially looking at that from, a longer perspective, a couple months out may save you a little bit of money in the long run.
For sure.
Being able to then analyze whether this is a refinancing play, or if you're going to try and sell it. The problem is if you try and sell it and it's at a higher cap rate than the one, when you bought it, essentially you're looking at a lower valuation.
I mean, I'm sure you'll touch on this later, but that really, hold on, chair's so high.
I know that. Yeah, no, these are high chairs.
But you'll probably touch on this later, but I think that's when you have creative structures, right, that really help out in the real estate investment process. And, but to kind of answer your question, like, so hope you don't mind. But I'm gonna break this down, right?
No, go for it. Yeah.
Let's take the cap rate structure. Like, let's just understand like how valuations are impacted by cap rates and what we're seeing by higher and lower cap rates, right? And so, typically, for whatever crazy example, let's say that you have a $1 million NOI property, 10% cap rate. What is that? Like, that's around 10 million, right? 10 million in value, right? And say that same year, you enter a higher for longer environment. Let's say that interest rates bump up, or for whatever reason, you are maybe it's a mix of interest rates are bumping up and vacancy has increased in the area or in the specific sector, right, of real estate. So we'll just take office, for example, right?
Yeah.
Let's just say that for whatever reason, and none of this is really like, this isn't based off of anything, right?
Yeah.
Say that
You're just
that
using
same,
this as an example.
yeah,
I get you.
right?
Yeah.
Say that you perform at that same building, right? You got that valuation of $10 million. You took a loan against it, and say that you wanted 60% LTV. You're at $6 million loan, right?
Yeah.
So now, in that same, let's say around that same time, you still have $1 million of NOI for whatever reason, right?
Sure.
Your loan's about to amortize. It's about to come due, right?
Yeah.
And so
Sure.
that balloon payment is coming,
Yeah.
right?
Yeah.
And so, what's it? And so, as you're doing this, you enter that higher interest rate environment. You're in office, and now cap rates have expanded just a little bit. So let's say that now you're at a 12.5% cap rate in that area.
I mean,
that
an
same
insane cap rate.
insane. Well, 10% was a little wild.
No, I know. I mean, starting off at 10, I was like, woo.
Right.
No, I mean, hey, maybe,
Yeah.
there could be some areas like that.
Right. Exactly. You know
But
what?
no,
In
I think
office.
I know in office.
Maybe.
Right? No, maybe. But
Right.
I for the sake of the
Yeah.
conversation, yeah.
Yeah. And so now that the value of your property has decreased substantially, now you're at 7.5 million as opposed to the original 10 million. What does that mean for your loan to value? You're not at 60% anymore. You're somewhere around like 90, 92, 93%.
1,000%.
Right. And so with that becomes your loan, your loan convents, right? Like if you are at this amount, it's your, I can't think about that.
Like the loan covenants,
yeah,
your
the loan
DSCR.
covenants. Yeah, exactly.
Yeah,
That influences your debt service coverage ratio.
Right.
Right.
Yeah.
And so that influences your valuation. That influences how much equity you're actually able to juice out of the property.
Yeah.
Right.
Yeah.
And so the question being, for real estate, what are we seeing right now? I think the higher for longer environment sucks. Like, period. I mean,
Yeah.
for real estate investors, I do understand, just as an economics major, I understand what we're doing, it's just, but it's, when you're looking at real estate, that it does get a little tricky. You don't want to exit a property when you're in that higher for longer interest rate environment, and as you mentioned before, you're looking at environments where these properties were financed during 2020 or 2019,
Sure.
right? 2021. Well, maybe not 2021, right? I think towards the later end of 2021, early.
I think whenever there was like an environment where cap rates
Yeah.
were, because arguably if you invested into like a little bit of a higher cap rate, right?
Yeah.
Like a slightly higher one.
There was a
not too much to the
Yeah.
point where it can screw you over, but to the point where it's a little bit higher, and then you obviously exit at a lower one, right? That's like the simple math behind it, and you exit at a lower one with a higher valuation.
Exactly.
But yeah, no, continue.
Yeah, no, it's interesting to see. Obviously, you don't want to see that happen for your properties, as you mentioned. And so when you're looking at the original question being like, okay, where is real estate right now? I think it really just depends on the segment and what instrument you're using to invest, right? And in some cases you'll
What do
have
you mean by
these-
instrument? Like,
well, I mean, there's different structures.
Oh,
and
okay.
so,
Yeah,
And
gotcha.
you could have that fund structure.
Yeah.
Maybe you're syndicating. Maybe
Yeah.
you're doing like a joint venture, right?
Yeah,
Where
yeah.
50-50, you and your partners or something like that.
Gotcha.
Right. But it really comes down to what you want as an investor. If you want stabilized cash flow, and like I hate to say it, but like real estate is really like one of the best plays there is.
Oh,
because
for sure, yeah.
especially if you're in a strong market, if there's strong fundamentals behind it,
Yeah.
real estate valuations, whatever they may be, however they may be influenced, right? If you're looking for strong cash flow on a year-over-year basis, that's probably where you're going to get it. And that's where that innovation for structures that you use to invest really comes in handy, right? And so, also it presents a new opportunity where if you are selling that asset, right, say at a lower valuation, you might be able to, you might be able to, if it was something that fit your investment criteria, to sell to a DST, to get that, to maintain that cash flow, right? You still might be able to, yeah, it really depends. I won't, touch on
No,
specific
you're okay.
structures,
Yeah,
but,
yeah, yeah.
or you could 1031 exchange, right? There's so
Right.
many different options that you could kind of go into. But real estate as a whole, do I expect,
The maturity is,
do
yeah.
I expect maturities and the maturity wall to influence what will happen? Absolutely. I
Yeah.
think that it really just depends how much of private credit is invested in real estate,
That's a good question
right?
too. Yeah.
Because
It's a
if,
very good question.
let's say, what was it, 45% in software and technology?
Yeah.
If that other 55% is in real estate,
Yeah.
ooh, it's like that's going to be
Yeah, I
kind of
know.
rough.
So from now to 2028, it's
Yeah.
expected to see pretty much about 40%
Yeah.
of all private credit to be invested into AI. So yeah,
Yeah.
right, like what you were saying.
Yeah.
Now, I mean, that's the other question is like, okay, now we're seeing, this influx of maturities, right, into and perhaps even we see a decrease in property values or something related to that area, then if private credit's also heavily invested in commercial real estate, whether that be through some sort of short-term bridge,
Right.
or some sort of some type of investment that way or lending that way, then you also have exposure to that aspect. But it's interesting because the maturity wall that you were saying, like essentially in using your example, obviously the refinancing risk of the higher interest rate environment. The aspect is like real estate's actually been very, very resilient.
Absolutely.
For 2025,
Right.
as opposed for 2025 terms, where you see essentially 2025 proved to be a little bit more of a transition period than a collapse. While 957 billion in scheduled maturities was nearly triple the 20-year average, the market did not experience a massive default wave like a lot of people actually assumed it would.
Yeah.
Instead, borrowers refinance into new facilities, albeit at a higher rate,
Yeah,
right?
yeah.
Of course, across multifamily and industrial.
Right.
Now, I think when there's a massive need for lenders to deploy capital, they have a lot of dry powder on the side.
Yeah.
And they're essentially able to utilize that into, commercial real estate assets. Obviously, there's this ability for them to be flexible with, the rate with, if it's SOFR 450 compared to SOFR 300, depending on, what, are there periods of interest only. I think as a real estate investor, there's a good chance that you'd be able to, refinance at a higher rate, given these negotiable terms and all this dry powder that these commercial real estate lenders may have on the side, this deployed capital that they're able to, allocate towards your property. Office market, however, did take a hit from the 2025 maturity wall.
Oh, for sure.
Many maturities resulted in loans being transferred to special services and undergoing formal workouts as well.